Welcome to the current federal tax developments for the week of April the 22nd, 2019. Current federal tax developments are brought to you by Kaplan Financial Education and by your state Society of CPAs. I'm Ed Zollers, broadcasting this week from Phoenix, and we're going to go over what's happened in this week following the tax deadline date, as all of you have recovered, hopefully, from your April 15th deadlines, and we'll talk about what happened. It turns out the IRS got a little busy this week. So as we close out and sunset our tax season, the regular tax season, get into the extension mode, we're going to start talking about what the IRS did. And I think it's pretty clear from the release date, especially of the first thing we'll talk about, that the IRS was holding some stuff until after the due date passed. They decided that they'd let that date go by first, especially for the first item we'll talk about, because there's obvious reason why they might have expected some complaints had that appeared just before the due date. But we now have something to work with, so we'll talk about how that goes on. So as we close this out and now watch the days begin, and unfortunately for those of us here in Phoenix, begin to watch the 100-degree highs and higher, we'll see how close we get it. We go above 120 this year. All that gets started. We'll start talking about what's going on now in taxes in general. And the first thing, which I mentioned right off, is, and the draft forms are dated April 15th. We actually saw them on the website on the 16th of April. The IRS has released draft forms to be used for computing the 199 Cap A deduction next year. You may remember this year, we just had a number that appeared on line 9, and we had various worksheets the IRS had put together to compute that. We had all come up with ways of computing. I think a lot of us had developed spreadsheets while the regulations were in place. So all this stuff, we just had this line 9 number. That was our 199 Cap A that pretty much was a single number that came out of what could have been a very long series of calculations and steps to get to that one number. Well, the reason the IRS offered for why we didn't have a form was they didn't have time to program their systems to handle a form for this tax season. So what the IRS did was they published these worksheets that were in publication 535, and we were to use those this tax season. A lot of our software put those on as attachments at the back. Well, what's going to happen next year is we're going to get a new series of forms. And as was kind of mentioned on Twitter quickly, it's a little bit weird. The short form does not have an A. The long form has an A, which is kind of interesting, but, it's one of those odd things. Form 8995 is the Qualified Business Income Simplified Computation, longest title for the form. What that form is for people who are essentially below the threshold amount. So we don't worry about W-2 wages. We don't worry about specified service trades or businesses. There are various things that just aren't a problem, and it's a much simpler calculation. That's something we discussed all last year, that, if you're below that level, this calculation is pretty easy. When you're above that level, especially if you're only 100,000, no more than 100,000 if married, filing joint, or 50,000 if single, or other filing status, head of household, etc., that could get a very, very hairy and involved calculation that took you forever to work through. Well, this is a nice, simple, not even quite a full page form, bigger than the postcard area that we have in the Form 1040, but still not a huge form that deals with simplified computation. The messy computations will be found on Form 8995A. That's just called Qualified Business Income Deduction. That form has all of the worksheets to deal with the phase-ins, phase-outs, to deal with specified service trade or businesses, to deal with all the, aggregation issues and all those other matters you may have to deal with. So all the complications go on the 8995A. If you look at the form, you're going to see that the worksheets, what we see there, the various schedules, are, parts are basically what we had this year as schedules on the worksheets we found in publication 535. So we've just now moved those to forms. As I said, the key difference, why a form? The main reason for a form, to be totally honest, is from the IRS's perspective, that's something the computer can check, while, the worksheets are something that we're not going to put into the computer. So next year, we expect the computer to be checking, at least looking at some of this stuff and doing some of the computations. This year, it's a totally manual deal. Now, these forms are basically, as I said, just a moving forward of those things in the worksheets. They are kind of useful. You can take a look at them, but you should be doing pretty much what's on those forms now is what your software is probably turning out now as a schedule in the back of your returns. But at least next year, you'll know that we'll have these brand new forms to work with. So you want to take a look at them. The IRS has them online. We don't yet, as far as I could tell, I didn't see instructions posted for these forms yet. So we don't have instructions at this point. But we do have the forms. And obviously, the IRS issues draft forms with the theory that you will be able to make comments on them if there is something you think should be changed or should be modified, especially when you've worked this year with the worksheet versions of them. Now is the time to speak up and go forward. Now, the IRS also, as I said, it was a very busy week for the IRS. They issued a set of proposed regulations, one of which we'll talk about later, got a lot more notice. This one, though, is kind of interesting. Proposed regulation 117062-18. It was issued on April the 19th. These are proposed regulations dealing with electing small business trusts and non-resident aliens. The Tax Cuts and Jobs Act added a special new rule that allows a non-resident alien to be a potential current beneficiary of an electing small business trust. Now, as you should be aware, previously, every potential current beneficiary of an ESBT had to be an eligible S corporation shareholder. This means that if we have a trust, if we had a non-resident alien as a potential beneficiary, even if that person got no distributions during the year, because on an ESBT, distributions could be fully discretionary. But if they were a potential current beneficiary, that would cause your trust to be not a qualified trust, and that would cause your S corporation election to go away. Now Congress said, we should be allowed to do that because Congress's theory was, read this in the committee reports, that on ESBT, we divide the trust into two pieces, and the S corp portion is taxed at the highest individual rates. And even it doesn't matter if we make distributions to the beneficiary, nothing matters, the trust pays the tax. So Congress reasoned, well, there's really no problem here because since the trust, a U.S. trust has to be involved, and the U.S. trust is going to pay the tax the highest rate, that there's not going to escape taxation, which is one of the concerns we have about why we don't have non-resident aliens. If you had an S corporation, non-resident alien was a shareholder, the problem is the flow-through income, A, if it wasn't effectively connected income, would not be subject to U.S. tax, and B, we could very well have treaties with those countries that would make them not subjected to U.S. tax. And since it is a corporation which otherwise would have to pay tax on all of its income if it had not made the S election, that, we aren't going to allow non-resident aliens because we want this, you're elected corporate means there has to be a U.S. tax. Well, Congress said, well, there's no problem, we can do this. The IRS said they forgot about something. The IRS was concerned that if this trust is a grantor trust with regard to the non-resident alien, under the grantor trust rules, the grantor, the person who is treated as the grantor, normally it's the grantor, but there can be cases, there are situations where a non-grantor can become treated as the grantor in a grantor trust. If that person, was considered to be as a grantor trust, it could still make the ESBT election because it would qualify based on all the rules, and the non-resident alien shareholder wouldn't block it. But that would mean that when the income came out, we'd have all the problems they were worried about. The IRS had ruled years ago that the grantor trust rules basically take precedent over the ESBT rules. Now they're saying, well, with this in the mix, we are not sure that's true anymore. So they're going to say now, generally the old rules, grantor trust rules take precedent, apply, except if a non-resident alien, to the extent a non-resident alien is deemed to be the grantor and gets allocated some or all of the assets of the trust, the S corporation portion of the trust will not be treated as part of the grantor trust and will be treated as an ESBT and taxed under ESBT rules. So that means non-resident alien, it will not flow out directly to non-resident alien to pay taxes on. Rather, it will end up being taxed at the trust level under the electing small business trust rules. That's meant to force paying U.S. tax on the income. Now, I've been thinking a little bit about this, and this is not really an area I play around in a lot. But it seems that what we've done here, though, now is said that really we can have non-resident alien shareholders in a S corporation, or even resident alien shareholders, because the problem with resident alien shareholders in the past was what happens if they change their status? If their status changes, they go back wherever, and then they become non-resident alien. As a non-resident alien shareholder, they would kill our S election. We had a private letter a couple of years back where they didn't discover that a shareholder had moved out of the country until after he'd already moved. That still wouldn't be totally solved here, but it does suggest that one could put those shares into a grantor trust. And if the non-resident alien ever left the country, that would be mandatory that the trust make an ESBT election. If they ever left the country and became not a resident alien, right, a non-resident alien, and you could therefore still keep it. So we could lower the risk apparently of doing it. Or even if we wanted to have the shareholder, maybe we have somebody working for us we're a tech company. We have somebody, who is working for us in Japan. We really want that person to be part of the company. We want to give them an equity stake, but we're an S corporation. We don't want to lose our S status right away. Well, we apparently could set up a trust at ESBT and just have the trust pay the tax, and then he can go ahead and take the money. It's a grantor trust otherwise. So it may set up some planning opportunities here. It'd be interesting to look at and think about. Maybe getting all that wrong. As I said, this is not an area I play in a lot. I have dealt some with ESBTs. They've generally not been a tax planning issue because you do it for other reasons. This could be another one of the other reasons you'd use an ESBT, but it could be an interesting one to use it. Other issue the IRS came out with this week, they came out with Chief Counsel Advice 2019-1201. Actually came out late the prior week. We're going to talk about it this week. It is a Chief Counsel Advice that deals with an issue of S corporations and the 2% shareholder rule. Now, here's the catch. Section 1372 of the code says that fringe benefits for 2% shareholders are treated as if they were paid to a partner of the partnership and treated as guaranteed payments. And then it goes on to say that we're going to consider who's a 2% shareholder by also including those who own shares by attribution under Section 318. The question that had been proposed in this, that gave rise to this memo was, what happens to, let's say, I own 100% of the S corporation. I hire my daughter. My daughter owns none of the S corporation shares. But my daughter, by attribution, is deemed to own my shares. She becomes a 2% shareholder. Now, she's an employee. She's legitimately doing the work, same work as 3 other people in the company are doing. Let's say she's a salesperson. She's one of 4 salespeople in the company. So she's a salesperson. She's offered the medical coverage we offer to everybody in the company. Now, here's the catch. Because she's a 2% shareholder, I can't claim the deduction. I have to put it in her W-2. But she's not really a shareholder. There's not going to be a K-1 on her return from this S corporation. Can she, with a tax return that shows only W-2 wages, is she going to be able to claim the self-employed health insurance deduction? That just looks weird. And may look weird, but the memo concludes, I think, very properly that those individuals are allowed to claim the self-employed health insurance deduction so long as they otherwise qualify. Remember, if my daughter is eligible to be covered, let's say she works for somebody else as well, and that other company has a subsidized health plan, she can't get the self-employed health insurance deduction. Let's say she's eligible to be covered under her spouse's plan, then a subsidized plan, then she can't get the deduction. But if none of those are true and otherwise qualifies, we meet all the other requirements, then she can still claim the self-employed health insurance deduction on her 1040 for the year in question. I think the ruling is totally correct. It's always been the way I assume this works, but I know some people would get nervous seeing a tax return with a W-2, no Schedule C, no K-1s, no flow-through income, and self-employed health insurance deduction. Perfectly allowed in a case like this. Now, the big story of the week that got all the coverage was the release, Reg 120186-18, on April the 17th, 2019, of the second set of proposed regulations for opportunity zones. Now, these are, 169 pages of regulations, right? The second set. We're not going to walk through those regulations today. I mean, first thing is I've not actually been able to slog through them all yet. I've had other things going on this week to take care of, so I've not slogged through and done a full-blown analysis of those regulations. I hope to have some time this week, as I'll be doing I'll have to update some manuals, but I also have hopefully some time this week because I will have 2 cross-country flights. I have to go to Atlanta, and then I have to come back from Atlanta. And so I'm going to have a few hours on an airplane each way. So presumably, if nothing else, I can put the regs on a tablet and just start reading the regs, if nothing else, on my way back across country. So I should have some time to look at it by then. But right now, obviously, I haven't done the dig, but we've got some interesting issues. The regulations do give additional rules on investing in such funds, the rules for the 10-year holding, how all these issues come into play, how we pick up that extra income on the deferral and all those issues. It also deals a bit with the problem of 1231 gains. 1231 gains are becoming a problem in multiple ways. Remember, they were paying for us. We looked at Section 199 Cap A because we had the issue of they're not qualified business income, because the problem is they could be taxed as capital gains. They could be taxed as not. This presents a problem with opportunity zones because we can reinvest capital gains in opportunity zone and get a deferral, but we cannot reinvest non-capital gains. And it's really a fun for a partnership because we don't even know at the partnership level if the 1231 gains will or will not be taxed as capital, because that's not going to be determined till the partner does his or her return, because they might have other 1231 gains and losses that are going to play into this. So it's kind of a mess. Well, they give us a bit kind of guidance. They do tell us that we have to wait till the end of the year to determine reinvestment. So reinvestment dates for 1231 gains are at end of year. That may prove to be a problem because some people may, obviously there's this big gain. We have this opportunity zone. We want to put the money in. We found what we want to work with. That could be a problem. We'll see how that works out. They also did, remember, in the original set of proposed regulations, we got a very limited set of discussion of what substantially all means. Because we just had one area and we were told it didn't apply to the others. These regulations give us the additional definitions of substantially all as they apply to other purposes. And there are a number of things, as the regs tell us, in the substantially all. A number of areas have substantially all. We do not use a one-size-fit-all percentage for substantially all under these regs. You'll take a look at these issues and see how they work out, but we do have those in play. A surprising announcement when Treasury announced these at the press event where they announced them was that the Treasury officials indicated that they did not expect to issue a third set of proposed regs. Almost all discussions prior to the release of these regs thought there would be 3 sets of proposed regs issued, that there would be this set and then there'd be another set coming later. So we'd have 3, there'd be 3 passes at this due to complexity. I think the IRS is feeling the pressure from people saying, wait, we've waited so long to get this guidance. We're not able to start up these investments because we have these unknown items. I think the IRS wants to say, okay, we got everything answered now. Just you can go ahead and do whatever you want. Do what you want to do on these things. There's a lot of speculation that they're not going to be able to hold to that. That in fact, there are still a number of unanswered questions, and that the level of things they're going to have to do to answer those questions are beyond the types of modifications they can simply make in going from proposed to final. So they'll probably have to send out another set of proposed regs. We'll see how that works. Nevertheless, if you are you're looking at setting up these opportunity zones funds, or you're looking at investing in them, clients looking at doing those things, you want to take a look at these rules, see how they work, take a look and see if this will actually function. Obviously, some people have already started things. If you already tried one, you already got one going, you want to go now back and check and make sure your assumptions about how this is all going to work out actually are going to hold true. That's probably also a big deal that I think a lot of people are a bit worried about. So, you may want to go take a look at that. Again, 169 pages, but if you're in this area, it's 169 pages of required reading. So you want to go take a look at that. Now let's go to our final case of the week. This is a case from the Ninth Circuit Court of Appeals. This is the case of Baldwin versus United States from the Ninth Circuit Court of Appeals, case number 17-55-115 and 17-55-354. The opinion was issued on April the 16th, 2019. It reversed the decision of a district court that found, that denied the government the right to essentially say that this case should be dismissed for lack of jurisdiction because in essence, they filed, in essence, what was a claim for refund, I got to get this correct, was filed too late. So there is no issue to go before the court. The Ninth Circuit revisits something called the common law mailbox rule. Okay, now let's talk about what that rule is. Under common law, there are some things that need to be given to, or let's say filed with, various agencies, and you may be allowed to mail those things in. The common law mailbox rule is, like all common law things, it's not actually anywhere found in statute. It's been a concept developed by the courts over the years that says there is a presumption, so long as you can prove, by, adequate evidence, you can show, meet your burden, whatever that burden level may be for what you're trying to prove. Generally, you've got a preponderance of the evidence. By preponderance of the evidence, if you can show that the document was mailed, then there will be an assumption that the document was delivered, right? So you could prove. So if I had my tax return, if mailbox rule applies to tax returns, if I have my tax return, I have everybody in my office watch me put my tax return in the envelope, seal it up, address it to the IRS, and then they follow me to the post box, to the mailbox, and they watch me drop the package with the tax return in the mailbox, that would serve as basically proof that I had timely filed my tax return. The question becomes, is that going to work? There is section 7502 of the Internal Revenue Code provides the postmark rule we're all used to, right? And 7502 tells us that if we send something to the IRS, if it has a postmark on or before the due date for filing the document, that is deemed to be the date the document was delivered to the IRS, so long as it was delivered. Also, 7502 added another provision that says, if, however, now remember, that required the return to be delivered. If it never makes it to the government, it gets lost in the mail, then the postmark rule doesn't apply if it never got to the IRS. That 7502 statutory rule doesn't apply unless it gets to the IRS. However, there's a second rule that applies even if it doesn't get to the IRS. If we use registered mail, by statute, so long as I have proof of registration, I have a document, the receipt stamped by the Postal Service, showing registered mail with a date when I provide it to them, that is considered prima facie evidence of delivery of the document to the IRS. The burden shifts to the IRS to show that they never got the document in question, or to show something else was in that envelope. Basically, and they have the burden of showing that, and that's a burden, to be totally frank, they are never, I won't say never, maybe there are some odd situations where they could actually overcome that burden, but it's going to be highly unlikely they can do so. The rule also said by regulation, the IRS could expand the registered mail rule to cover certified mail. The IRS has done so, and again, with certified mail, which is less expensive than registered, and to the Postal Service, much less of a pain for them. Register certified mail, as long as we have that receipt that is stamped, we're good. It is deemed to be in the IRS's hands, and the burden is on the IRS to show that we didn't send them the document, or the document was never delivered. And again, that's going to be virtually impossible for the service to show. Prior to issuing regulations in 2011, there had been some dispute as to whether 7502 was the exclusive way you could prove timely filing, or just safe harbor ways of proving timely filing. Prior to 1992, in the Anderson case, the Ninth Circuit had ruled that it was just a safe harbor, that so long as you could prove mailing, and the court did make it clear, it takes a lot of evidence to prove that you meet the mailbox rule, but as long as you could meet the mailbox rule, that you were deemed to have properly mailed the return in, and now the burden shifted to the IRS to prove that, they hadn't received it. Well, You know, what happened is the IRS issued regulations limiting proof. In 2004, 12 years after the 92 Anderson decision, the IRS issued proposed regulations that stated that 7502 registered certified mailing would be the only way of proving timely mailing, timely filing of a document with the service. By the way, there are similar rules that apply to electronic filing, but obviously we're not proving a document went anywhere in electronic filing. We're proving the electronic transmission. That's a slightly different provision. We're just going to talk about documents here. Now, that was proposed with an effective date back in 2004 when the regulation was issued. As we discussed last week, generally regulations cannot have retroactive effective dates, except unless they're issued within 18 months of the date the law is passed, or if it's necessary to stop tax abuse. Well, that wasn't going to qualify here, so they did that. Now, it still took them a while to finalize this. It took 7 years. In August of 2011, they finalized the regulations, and the regulations went final. But you had been put on notice in 2004 that the IRS was planning to force you to have to use these 7502 protections to file. Now let's go to our case in question, Baldwin. Mr. Baldwin had filed a claim for refund. Now, that claim for refund was due by October 15th of 2011. Okay, that was the due date for filing his claim for refund related to a net operating loss, as I recall. He filed that claim for refund. He says he filed it in June. He produced evidence from his employees who testified that the document had been placed in the mail in June of 2011. In August of 2011, the regulations went final. And come October 15th of 2011, per the IRS, they have no record of ever receiving the document. Eventually, of course, the taxpayer starts asking what happened here. I mean, we're all used to the fact that, amended returns take a while to get processed, but the taxpayer got a little concerned, and eventually the service said, we have no record of it. The taxpayer then sends this back in. The service says, okay, fine, now I have a record, but you're not timely. And so the taxpayer then sues in district court. The district court, going back to the Anderson case, says, well, yeah, 7502 is there, but the Ninth Circuit told us the mailbox rule works. And we believe, and in fact, the court went even further, we believe that the regulation is invalid. The court had to invalidate it because clearly if the reg is valid, it was okay that it was issued a few months after they supposedly mailed the document. Because again, they'd been put on notice in 2004 that the IRS was going to force this change. So anybody filing from 2004 forward who relied on the mailbox rule very much did so in the Ninth Circuit at their own, basically at very high risk that it might not hold up if it ever got challenged. Well, the court said it wasn't in line with the clear language of the statute. The Ninth Circuit on appeal reverses. The Ninth Circuit said the Anderson case did not say that the law under 7502 was clear, that it was a safe harbor. They said, rather, if you read the Anderson case clearly, it said it wasn't clear one way or the other. The court had specifically said that this is a new area of law for us. It's not been decided before. We're going on the side of the mailbox rule applies. The panel noted that one problem at that point was other circuits had considered the exact same question and had come to the opposite conclusion, that you had to only use 7502 as the only methods available to prove filing. Congress had meant it to be a very clear statutory break. It was a relief provision put in because the original law required actual delivery to the IRS by those dates. The Ninth Circuit said these regulations are a valid way of resolving that ambiguity and the split in the circuits. The Ninth Circuit said the IRS could have issued regs that agreed with Anderson. That was a permissible interpretation. But they said this interpretation is not unreasonable. As such, it controls. For that reason, despite the fact that the district court found very credible the testimony of your employees that you mailed it, you probably did mail it. We agree you mailed it. But that doesn't matter. That will not allow you, since it was not delivered to the IRS, the only way you could solve your problem would have been to have used registered or certified mail. You failed to do so. As such, your Claim for refunds untimely. As such, the case should be dismissed. The Ninth Circuit sent it back to district court to dismiss the case. So the key takeaway here, if you've been here in the Ninth Circuit, those of us here in, Idaho, Washington, Oregon, California, Hawaii, Alaska, those of us in the Ninth Circuit, if you've been hoping the mailbox rule protects you, if you've been relying on Anderson and thinking you don't need to worry about certified mail, you need to worry about it. Clients need to understand the only way to prove it, now the Ninth Circuit has made very clear, the only way to prove timely filing is to get registered or certified mail. And remember, the key issue is not the little green card. As I tell people, the little green card makes you feel better, doesn't help a bit in this area. What I need is the white receipt, because what we're protecting for in this case is not whether it gets postmarked on time. Well, we protect that a little bit. We could actually protect that at the post office. Rather, what we're protecting is what happens if it doesn't get delivered. The IRS asserts lack of delivery. The only way you can overcome an assertion of lack of delivery is to use registered or certified mail or the electronic filing alternative option, not using documents. So be very clear where this goes. Be careful in this area. Well, it's that time of year. CPE season is upon us. So make sure you register now for your 2019 continuing education. It's all coming. It's going to be, getting ourselves up and running. It is CPE season. Be sure to check your state society's website for the courses coming up. I'm already going to be doing sessions. As I said, I'm going cross country Atlanta this week to be in the Georgia Society's Decision Makers Conference. We've got, got courses coming up in May, June. Your societies will have courses coming up all throughout the summer. They'll be web-based. They'll be live. You'll be able to do whatever you want. And as I noted last week, we talked about last week, all the guidance we know is coming this year. It's going to be an important year to keep updated. So be sure to check, outline what you want, get signed up for your CPE, and we'll hopefully see you at one of the courses later this year. This has been the current federal tax developments for the week here of April the 22nd. Got to remember, which is still funny. You can't remember April. Okay. But April the 22nd of 2019. You can catch our updates online, currentfederaltaxdevelopments.com. We've got information there. As we post our updates during the week, we write those up. If you have any questions or comments, you can send them to me, edzollers@currentfederaltaxdevelopments.com. I also, on Twitter, you can follow me there at Ed Zollers, and also you might want to follow Tax Twitter. It's a hashtag #TaxTwitter. You can actually, do a search on that, and topics tend to get posted there. We're not absolutely perfect at posting links to that, but it's useful sometimes. The problem is it's a long tag, so it takes up a lot of your characters, but we'll hope you can still follow. There's a lot of people. If you do some Tax Twitter, you'll quickly find the people to follow that are talking about tax. Believe it or not Game of Thrones, all those things. We're not talking about those, talking about tax or what we had for lunch this week or any of the political fun stuff. You can talk about the tax stuff, which is what I'm on Twitter for. Also, I do follow discussions on the groups for the state societies, Connect groups. The 3 Connect groups I follow are with Arizona, New Jersey, and Minnesota. So I do try to take a look at questions posted there and issues posted there. Don't have time, I can't jump into everything, but I try to keep a look at. Also, I take a look at California's Tax Talk group, the Cal CPA Tax Talk group. That group is open to any CPA anywhere in the country. You do not have to be a member of Cal CPA to be part of that. So you might want to take a look in there, or take a look at your own state society, see if your state society has such a group, because these are really useful resources. And again, IRS is probably going to continue to be busy. We told you last week we're racing toward that June 22nd date. They're looking to get a lot of TCJA guidance out by that date. So we're going to be seeing a lot of things happening over the next couple of months. So you want to make sure you keep up to date, and we'll try to keep you up to date here as we give you the weekly updates. So after I get back from Atlanta, see you next week here on Current Federal Tax Developments.